Hey, it's Cashflow Mike, and I was mowing the yard the other day, and I saw that Caleb Hammer was going to be on Joe Rogan. That's usually how ideas kind of hit me. I'm not sitting at the desk trying to come up with some big marketing angle. I'm outside, right? I'm doing normal, just pushing the mower back and forth, listening to something in my earbuds, and then one thought starts to just work on me, right? It just starts to get into my system. So I, I've known who Caleb was, and I've seen some of his clips, and I understood the basic idea of financial audit. People sit down, he looks at what's actually happening with their money, and then they have the conversation most people spend years avoiding, right? It's that one thing you just don't want to be told about yourself. And I think that's why his content works, right? It's not just the numbers, it's not just the shock of seeing what somebody spent at restaurants or how bad the credit card interest is. The reason it hits is because at some point, the person sitting there has to stop explaining and actually look at the pattern, right? It's a pattern recognition, it's a behavioral change. And that's uncomfortable, right? It's really uncomfortable. And when I tuned on or turned in the Joe Rogan episode just to hear him, I didn't take very long before I felt that in myself. I was not watching it thinking, look at all these people that make bad decisions. I was watching it thinking, man, I remember being that guy. Not exactly, of course, but everybody's story is different. I remember the feeling, right? I remember being younger and thinking that I was pretty good at figuring things out just because I knew how to move money around. And I could take pressure from one place and put it somewhere else. And then I could make a payment look better, right? I could create a little room on a credit card. I could move something into a home equity line and tell myself that was being responsible. That was the best move I could make at that point in time, just to give myself a little bit of breathing room. And sometimes it might have been, right? That's the tricky part, because the tool itself is not always the problem. The problem is when the tool shows up before the truth. And let me explain that just a little bit, right? That was the thing Caleb said, or at least the thing that I heard that stuck with me while I was mowing, that if you have credit card debt and you move it into a consolidation loan, the debt didn't disappear. It just changes addresses, right? And for a little while, that can feel like progress because the credit card looks clean again, right? The payment may feel a little bit better. The pressure backs off just enough that you can breathe. It just changes your perspective. But if the same person who filled up the card the first time is now looking at available credit again, and nothing's really changed in how they make their decisions, well, that available credit is dangerous, right? All you do is create more space for more debt. It looks like room, but really it might be the next trap. See, I know that because I've lived some version of that. And you don't know, or you don't mean to make the problem bigger. Nobody sits down and says, you know what, I think I'm going to double my debt this year, right? That's not how it happens. It happens quietly, right? You move the debt, the pressure eases up, you relax just a little bit, and then life happens, right? A purchase feels necessary. Something unexpected comes up. You tell yourself, hey, it's just going to be temporary. And because the card has room on it again, you use it. Well, then one day you wake up and you realize that you have the old debt sitting somewhere else, and the new debt has just grown right back in the place that you just cleared. Right? It's like mowing your yard. You get rid of the weeds, get rid of the tall grass, and then it just grows back. That's a terrible feeling. And it's humbling because on paper, the original move may have looked smart. It's a lower payment. It's a better rate. It's a cleaner balance, right? It's more breathing room. But underneath it, I didn't change. The behavior hadn't changed. This is what I kept thinking about while I was mowing. And the tool cannot outrun the behavior. It can hide it for a while, and it can soften the pressure, and it can give you enough time to really make a better decision, but it cannot make the better decision for you. And that's where my mind started, right? Moving from Caleb's world into mine, his personal finance into business, because I work with business owners. And the more I thought about it, the more I realized that I had seen the same story play out over and over and over again. It just doesn't sound the same when it happens in business. But it is. It's the exact same. In personal finance, somebody talks about credit cards and consolidation and balance transfers. We just use different words in business a lot of times, right? In business, the words sound more sophisticated, right? The owner talks about working capital and refinancing and restructuring and extending terms, freeing up cash flow, getting through a season, right? All these things. And some of that's probably completely legitimate. But I don't want this to sound like I'm anti-debt or anti-bank or anti-financial tools, because I'm not, right? There are times when debt is useful, and there are times when restructuring is smart, and there are times when a line of credit is exactly the right tool. It's the thing you need to grow, to get ahead, to get, more. But only if you understand what created the pressure in the first place. That is the part that gets skipped. I saw this recently with a company. I'm going to change the name because the company is not the point. So let's call it San Antonio Steel. Well, San Antonio Steel had a real business. I'm talking about real business, real customers, real employees, real activity. And from the outside, it would look like, it wouldn't look like a disaster at all. Matter of fact, you think it was very successful. It looked like it was a company just doing work. But there was pressure, significant pressure. And if you've ever owned a business, you know what pressure has. It has its own weight, right? It follows you around. It can be at dinner and you still feel it. You could be at a kid's game and still feel it, right? I could be mowing the yard and I still feel it. Payroll's coming. Vendors are waiting. A loan payment's due. The line of credit is getting tight. There's a customer that's supposed to pay last week that still hasn't paid his bill. All of these things kind of add up. It happens in your personal life. It happens in your business life. And when you're in that kind of pressure, all you want, and it's natural to do it, you just want some relief. You're not always looking for a big life lesson in that moment. You're just looking for some oxygen. And that's what San Antonio still did, right? They moved some money around. They created some room. The immediate pressure changed. And I understand why they did it, right? Because it's pressure. It's hard. But as I looked at the situation, I had the same feeling I had listening to Caleb. The money had moved, but the real question was still sitting there. Why does this business keep needing borrowed money to breathe? That's not an easy question. It's much easier to talk about the payment. It's easier to talk about the bank. It's easier to talk about the customer that didn't pay or is slow to pay. It's easier to talk about, the next job or the next sale, the next busy season, all these things, right? It's always the next thing that's supposed to make the pressure go away. But it doesn't. And if you don't slow down and ask why the pressure keeps showing up, you may just be given the same problem more room to grow. That is where Caleb's message connects so clearly to business ownership for me. He sits across from people who have income but no control. I sit across from business owners who have revenue but no cash. Those are not the exact same problem, but they are really, really close cousins. A person could have a paycheck and still be broke because the behavior behind the paycheck is broken. A business can have sales and still be starving for cash because the behavior inside the business is broken. And in both cases, the numbers are going to eventually tell the truth. They may tell it late. They may tell it after a lot of damage has already been done. But they always tell it. That is why this whole thing hit me so hard. It's a lot of people will follow Caleb or trying to get their personal finance life under control. And that's a big deal. But some of those same people are also going to try to build something. They're going to become creators. They're going to start a side business. They're going to freelance or open a shop, right? Where they have to buy equipment. They have to hire some people to help. They got to take on their clients and borrow money and call it growth. And I love that, right? I love it because I believe in business ownership. I believe it can change a family's future. I believe it can create freedom and wealth and purpose and options. But business ownership does not automatically make someone better with money. Sometimes it just gives their money a bigger stage. It gives their habits a bigger stage. If somebody has a habit of treating available credit like available cash in their personal life, guess what? They're probably going to do the same thing with a business line of credit. And if someone believes a lower payment means a solved problem, especially at home, well, they're going to believe the same thing with a business loan that gets restructured. If someone is good at justifying personal spending, they may become even better at justifying business spending. Because now every purchase can be dressed up as an investment. I'm doing this for growth. I'm preparing for the next step. Well, that's the word that can get dangerous, investment. Business owners use it all the time. I use it. I use it, and I understand why people use it. It sounds better than expense. It sounds strategic. It sounds like the thing that you're buying is automatically connected to growth. But calling something an investment doesn't make it one. A real investment has to return something. And that's where business ownership needs more honesty. If an owner is putting in their time and their money and their stress and their reputation or family stability, then sometimes their personal guarantees, right? Then this business has to produce. It has to produce more than activity. It has to produce enough return to justify what is actually being put at risk, your family. And that's where a lot of owners get surprised. Because the business may be busy, sales may be real, customers may be real, employees might be working hard, and the owner is probably exhausted, right? Because you're busy, and yet the business still isn't producing the kind of cash or profit or value that makes it a good investment. That is a hard thing to admit. It's much easier to say, hey, we just need more sales. And sometimes you do. But I've seen businesses grow and get tighter on cash at the same time. They can grow broke. More sales can create more payroll pressure. More jobs can create more material needs. More customers can create more receivables. More equipment can create more debt. Growth can be good, but growth can be, it can expose every single weak spot you have in your business. And that's why I get nervous when an owner is trying to solve pressure with motion, right? That is when they're heading for a disaster. That's what it felt like with San Antonio Steel. Not that they're lazy, right? They are not careless. They're not bad people. They were under pressure, and they were trying to keep the business moving and everything they could do. But the question remained, was the money being moved because it was part of a disciplined plan, or was it being moved because the business had not yet faced the behavior that was creating the pressure? I wrote 71 pages of turnaround plan for them that they ignored. That is a question that matters. And it is the same question Caleb is asking in a different way. When somebody comes on financial audit with debt, the question is not only, hey, where can we move this debt? The deeper question is, what has to change so this debt doesn't come back? That question belongs in business too. Before the owner restructures the debt, what has to change so the business does not end up right back in the same spot? What has to change? Something has to do. Before the line of credit gets more room, what has to change so the room doesn't get used the same way it was used before? It's a psychological problem. Before the business buys a truck, hires a person, or takes a loan, opens a new location, it has to change in how decisions are made. You have to look at the way you use money differently. This is where I think the bridge is. Financial audit is not really about humiliating people over bad choices. At least that's not the way I see it. I see somebody trying to get people to tell the truth before they reach for another tool. And that's exactly what business owners need. They need to hear that truth. It's the truth before the tool. Because if the tool comes first, it can become a very polished way to avoid the truth. I wish I'd understood that better when I was younger. I really do. I wish somebody had pulled me aside and said, Mike, moving debt is not the same as fixing the debt. You're not as clever as you think you are. You are just making the numbers quieter for a little while. You're just kicking the can down the road just a little bit. That would have stung, right? But it would have been true. And I think a lot of business owners might need some version of that same conversation. Not in a mean way, right? Not in a shame-based way, but in a clear way. Because sometimes the kindest thing you can do for somebody is help them stop making the problem bigger. That is what Caleb does in personal finance. He really focuses on that. That is what I try to do in business finance. And I think those two conversations are closer than people realize. The biggest investment you might have is your business. When a person becomes a business owner, the stakes change. The credit card may become a company card. The car payment may become an equipment loan. The side hustle, may become payroll. The personal dream may become a business that other people depend on. Right? You've got other people depending on your decisions, and that can be a beautiful thing. It can also become a more complicated version of the same financial pattern. And we're going to encourage people to build, to create, and own. And we have to teach them, right? We have to teach them how ownership behaves financially, because ownership is not just making money. Ownership is making decisions with risk attached. That's why I built a clear path to cash. Right? Business owners don't need another pile of numbers. Most of them already have enough numbers. They have accounting software. They've got bank statements and dashboards and reports and tax returns and somebody telling them that whether or not they've made a profit. But a lot of them still can't answer the question that matters. It's when the pressure shows up. What do I do next? That's a question, right? When cash is tight, what do I do next? When the line of credit is maxed out, what do I do next? When the business is growing, but the bank account is shrinking, what do I do next? When I want to buy a truck, hire a person, take out a loan, expand, all of these things are business questions, but the next thing is, what do I do next? And the answer can't be just move the money and hope the behavior changes later. Right? That's backwards. The behavior has to be addressed first. Then the tool can help. And that is why Caleb's Rogan appearance stuck with me. I started out listening to a personal finance conversation while mowing the yard. By the time I was done, I was thinking about business and business owners and their debt and their growth and their cash flow and the way that I have conversations with them and all the ways that people try to get relief before they're ready to repair the cause. So Caleb, if this makes its way to you, congratulations on Rogan. That's a huge moment, right? But what caught my attention was not just the size of the platform. It was how naturally your message extends to business ownership. You're helping people face the truth, about their personal money before they reach for another financial tool, even if it's dollar-wise. I believe business owners need that same kind of audit. They need that same type of conversation, because the person who finally gets control of their personal finance may eventually want to build something. They may want to become a creator, a freelancer, a contractor, a coach, even an owner. But when they do, they're going to run into the same question again, just in a new form. And it's this type of decision, right? Is it helping me build wealth, or is it helping me hide from a pattern? That's a conversation I think is worth having, because moving debt is not fixing debt. It's not paying off debt. Opening credit is not creating cash. And calling something growth doesn't make the business healthy. A tool can help, but only after the truth has been faced. I'm Cashflow Mike. And you guys know that moment. And the Clear Path to Cash was built for that moment.